We're going to be joined now by our economist here on Live Now from Fox, Michael Szanto. Thank you so much for joining us here on Live Now from Fox. Obviously, we expected 50 basis points from Jerome Powell and the Fed, so we continue with this kind of trend. Was it as expected, and what do we do from here?
Yes, 50 basis points was as expected. The talk from the Fed today, however, was a little bit tougher than expected, implying that they might be going a little bit longer and higher, and that this will persist for a little longer. And half of this is jawboning by the Federal Reserve, because again, they're trying to break any chance of inflationary psychological expectations. They're playing psychological warfare, because if people get too used to inflation, it becomes a vicious circle, and then it sets in, and they don't want that.
And obviously 50 basis points, less than, this is the 7th time they've increased interest rates this year alone, but it wasn't the 75 basis points that we've seen in past. This is kind of a change, though, like you said, they don't want to get into a cycle of it. You mentioned that they talked a little bit about they didn't want to get into a cycle of it. What does it mean when they say they don't want to get into a rut with inflation?
Oh, because if people expect prices to go up, they'll demand raises, and a lot of things are built on expectations. You know, we don't want companies too comfortable with raising prices, because they'll keep on raising prices, and then people demand raises. There's a whole bunch of mechanisms that you can read about in macroeconomics textbooks, but that's what happened in the 70s. It starts to feed into itself. I don't think we have that. You know, we had a rapid expansion of the money supply. The Fed got a little carried away during the quarantine. You know, there were some stimulating programs, and maybe perhaps more important still, supply chain disruptions. But they don't want this to take on a life of its own, so they're making an investment in pain now to prevent much greater pain over the long run.
And we heard them talk about 2023 as well a little bit, saying that it 5%, 5.2% by the end of 2023. What do we make of kind of that number and the forecast they laid out for 2023?
What they're projecting right now is a little bit higher than what people have hoped. And, you know, it could be actually end up worse or better. Sometimes the Federal Reserve seems to me a little bit like in the role of a teacher or parent with a kid who's in trouble in this psychological game. Hopefully the Fed doesn't really want unemployment and recession and layoffs and unpleasant stuff, or a weak stock market for the next 6 months, but then they don't want inflationary expectations to set in. So they're also jawboning. So it's like a teacher or parent saying, you're in big, big trouble. Now, if they let the kid completely off, the psychological expectation, the kid suddenly becomes a juvenile delinquent, they can do anything. So, you know, there's a parallel, psychological expectations. You don't want people subconsciously to get used to inflation. I mean, of course, it's different. You know, nobody's trying to be mischievous here, but they're trying to break that pattern, which is one of those things that economists are scared of, where it just sets in. It's hard to break out of it because people are always getting raises, and then companies have to raise their prices, and it just feeds into itself.
And I think a lot of people take away from this press conference today was also about unemployment, saying it will likely continue to rise, something that may need to happen to make sure we don't get in this rut of inflation. When he talked about unemployment, kind of what are your thoughts on that?
Well, I mean, part of that is also going to be an issue of immigration. We need skilled labor. We need construction labor. That's one of the reasons we're having trouble building houses without, you know, there's actually a lack of supply of houses. You know, you can look at people don't want mortgages now because the rates have gone up really rapidly. And they're not historically terrible rates. If you compare it to like most of the 80s, all of the 80s, in fact, these are not terribly high rates. So we do have a very tight labor supply. One of the ways that we managed over the last 20 years to make up for those kind of semi-tight labor supply was to outsource a lot of manufacturing to China. China is less dependable. We don't trust China as much. And maybe here too, somebody from India can rescue us, just like those poor people stuck in the ocean. Because, you know, there's a hope that we could start to have some of our manufacturing outside of China. And I love the story was that the guy who rescued the poor people stuck in the ocean was from India. And India can be one of the players who rescue us from our overdependence in China there as well. So maybe there's an India angle there too.
What a segue there, talking about the sailors off the coast of Delaware. Michael Szanto, economist, thank you so much for joining us, talking about this Fed Reserve and this new 50 basis point increase in the interest rate. We appreciate you joining us here on Live Now from Fox.
You're very welcome.
All right, thank you again, as we're following that very closely here on Live Now from Fox. Obviously, Jerome Powell at the podium earlier on today talking about this new interest rate increase that was going on. Of course, a lot of people keeping their eye on this interest rate as it goes up by half a point.